Welcome to the Credit Compass, helping you navigate the world of European credit, where we break down the biggest moves in credit markets, macro trends, and fixed income strategies shaping the financial landscape in Europe and the UK. My name is Gordon Kerr, European macro strategist and host. In today's episode, we will delve into the health of the consumer across Europe. We will look at recent data on consumer sentiment, household savings, debt levels, income trends, and delinquencies across the Eurozone, Germany, France, Italy, Spain, and the United Kingdom. Our aim is to provide a comprehensive understanding of the financial health and confidence of consumers in these regions as investors target the prospect for improved growth in Europe. It is our view that the European consumers are in a positive position, albeit not a perfect one, as we emerge from a cost of living challenge. Let's start with the regular market updates on confidence. For the Eurozone, flash estimate data was released just last week on the 21st of March. Here, the data suggests that consumers are struggling to feel confident in their situation. It is hard to argue against that with all the negative considerations in the press with risks of a trade war, as well as concerns about the actual ongoing war at the borders of Europe, plus ongoing challenges for economic growth. As a result, the consumer confidence indicator fell to minus 14.5 points in March, down from minus 13.6 in February, signaling a decline in consumer optimism. In Germany, the GfK Consumer Confidence Index dropped to minus 24.7 from minus 22.6 in February, reflecting growing household pessimism about the economy and income prospects. This could potentially turn more positive as the new government looks to invest more in infrastructure and job security improvements, and we would expect a more positive tone in the next survey results. In the UK, the GfK Consumer Confidence Index reported a slight increase to minus 19 in March, up from minus 20 in February, marking a 3-month high. In France, the sentiment has also been improving, with a rise in the February data up to a level of 93. Up from 89 in December and 92 in January. Yet it still remains below the long-term average of 100. Italian consumers are also more bullish on their prospects, with sentiment improving to minus 13.6 in February, up from minus 14.8 in January. So what does all this mean? Consumers are still cautious about their future as inflation remains above target and the risk of job losses remains elevated. However, taking a step back and looking at this more broadly, sentiment does still remain above the 2022 lows, but it is still below average pre-pandemic levels. So what other indicators do we have on the relative health of the consumer? For starters, unemployment levels have remained relatively positive, depending upon the country. For example, in Spain and Italy, unemployment levels are at their lowest levels in well over 10 years, at 10.4% for Spain and 6.3% for Italy. Further, France, while off its lows, remains on a positive trend at 7.3%, down from a recent peak of 7.5% in June 2024. However, on the other side, the UK and Germany have been deteriorating, at least on a relative basis, with their unemployment levels at 4.4% for the UK and 3.5% for Germany. Both are up from low levels in 2022 for the UK and 2023 for Germany. Nonetheless, they remain below pandemic level highs and below historical averages. So what does this tell us? There appears to be a bit of a divide here depending upon the country, but broadly speaking, all economies have relatively robust employment markets with levels well below those from a decade ago when Europe was still struggling from the Eurozone crisis. This robust job market has helped on several fronts. For starters, household savings rates have shown notable developments across Europe. In the Eurozone, the household savings rate was 15.2% in the third quarter of 2024, down from 15.6% in the previous quarter. But despite this decrease, the savings rate remains above pre-pandemic levels, further highlighting the continued caution amongst consumers. In fact, all of the major European economies, while some of the data is still relatively delayed, highlight a positive savings trend. I suspect this may in part be due to concerns about their outlook and taking lessons from being caught short either from the pandemic or the rise in interest rates. As a result, households in Europe are holding on to their savings as best possible, Inflation has challenged this, but the majority continue to save at higher rates than prior to the pandemic. Added to the savings, household real debt levels have been decreasing in most major European countries. Household debt as a share of disposable income dropped from its peak at 109.8% in early 2021 to under 97% in mid-2024. Broadly speaking, households have focused on debt reduction in the past several years, or at least decreased their demand. In terms of amounts outstanding, household debt levels have remained relatively stable across all countries. When you adjust for inflation, this is a decline in real terms, which helps their financial position. Income levels across Europe have seen modest growth, and in most countries, wage growth remains above inflation, producing positive real income growth despite the above target inflation levels in the past several years, and presenting a challenge to central bankers. Consumers agree, as inflation remains a key concern. Eurozone consumers have lowered their near-term inflation expectations, with median expectations for the next 12 months decreasing to 2.6% in January 2025, which is still above target levels. Inflation has the impact of eroding purchasing power, impacting consumer spending. However, if wages can remain positive on a real terms basis, the European consumer will maintain a positive financial position. The impact of rising interest rates and economic pressures varies across countries. In Spain and Italy, where the share of fixed-rate mortgages is lower, effective rates have risen more significantly, affecting household debt servicing costs more immediately. However, other countries, like the UK, face an ongoing challenge as mortgage borrowers roll off their previous fixed rates. 5-year fixes taken at the optimum time still have a little under 2 years to run. Insolvency and mortgage delinquency levels have been increasing in the UK, albeit off of low levels. One helpful gauge of the health of European consumers is KBRA's Auto ABS Loan and Lease Index results. These are published on KBRA.com on a monthly basis and provide useful insight into the current health of consumers across Europe. The vehicle remains an important asset to protect from delinquency, so when levels rise, it is an important indicator of stress. Here, the data shows that delinquencies and loss levels are on the rise. Loss levels are a story for another time, as they are not really fully related to the health of the consumer and have some technical aspects to them. However, the main takeaway from the indices is that delinquencies are on the rise. While they have been steadily increasing over the past year, they are hardly at worrying levels. Borrowers over 60 days delinquent have increased from average levels of 0.33% in April 2021 to 0.56% as of February 2025. This is well below peak levels seen in the pandemic period, but they are above the historical levels of around 0.4% prior to the pandemic. The main regions contributing to the rise have been Germany and the UK, and some of the other smaller regions. As credit investors know, a major driver for delinquencies and consumer defaults is unemployment. This rise in Germany and the UK fits with their respective increases in unemployment, again, albeit low levels. These trends suggest that while some consumers are managing to maintain their financial obligations, others are increasingly facing financial difficulties, leading to higher rates of delinquencies and insolvencies, and again, albeit far from recessionary levels. So, what conclusions do we draw from all of this? The differentiation of markets continues to come to the fore, with Germany and the UK challenged, but far from distressed, while Spain and Italy and even consumers in France are looking relatively positive. How they will be impacted by recent tariff discussions is yet to be determined, but the overall health of the European consumer in early 2025 reflects a landscape of cautious optimism tempered by economic uncertainties. While consumer confidence shows slight improvements in certain regions, overall sentiment remains below long-term averages. Household savings rates indicate a preference for financial prudence, and debt levels are generally declining, yet the burden varies across countries due to differing mortgage structures and interest rate impacts. Income growth offers some relief, but inflation continues to challenge purchasing power. As we navigate these complexities, understanding these dynamics is crucial for policymakers, businesses, and consumers alike. Hopefully, the European Commission can enact policies to help take some of those high savings rates and invest them into future growth. Thank you for joining us in this exploration of the current state of the European consumer. That's all for today. Be sure to subscribe for more insights, and we will speak to you again soon. As always, staying informed is key to navigating these complexities. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.